All right, options traders, listen up. I want to tell you a bit about public.com, but first, have you ever actually thought about all the fees you're paying to trade options? Aside from the regulatory fees, there are commissions, and most platforms charge per contract fees too. That's what makes today's sponsor, public.com, so interesting. Public doesn't charge commissions or per contract fees, and in an industry first, they offer a rebate of up to 18 cents per option contract traded. Check it out. If you trade 1,000 options contracts on Public, you'll get up to $180 in rebates. If you trade 10,000 contracts, you could earn almost $2,000. More importantly, the rebate means you can maximize your profits and minimize your losses. To recap, no commissions, no per contract fees, and up to 18 cents on every contract traded. See why NerdWallet recently awarded Public 5 stars for options trading and start earning up to 18 cents per contract traded only at public.com. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only.
Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Okay, welcome in to Chit Chat Stocks. My name is Brett Schaefer, and as always, joined by my co-host, Ryan Henderson. Today, we are doing our Wednesday. Well, I guess we've been mixing it up in 2024, trying to spice things up, but we're doing another stock research episode. We know the loyal listeners, the ones that have been around a long time, the ones that stick around, like these episodes a lot. At least we get notes on that all the time, so we keep doing these at least once a month for each of us, so in total about twice a month. And we are hitting Fintech and Remittance Disruptor Wise, formerly TransferWise. You may have heard of the brand before. This one has been researched by Ryan, so he's done all the research. I haven't even looked at everything he's done yet, so I'm going to be reacting to a lot of the stuff he's saying, and I'll be the one asking questions in a semi-formal interview style. Two housekeeping items. There will be a newsletter associated with this podcast. There will be a link in the show notes. It's going to have a lot of the notes Ryan made and a lot of the charts that we're talking about on this episode that I think will help. If you're looking at Wise, maybe you're just listening to the podcast, not watching it on Spotify or YouTube, it can be really helpful to visualize some of the things that Ryan's talking about here. And then the last thing, if you are listening on Spotify or Apple, take about 5 seconds out of your time here and give us an old 5-star review on either of those platforms as a free show. That is the best way to help us grow. So Ryan, let's get right into it. Maybe we can talk about how you discovered Wise, what Wise is, how it runs its business.
How I discovered it is actually, it's probably the way I most like to discover an investment, which is through actual product experience. So kind of one of those wow moments where you're like, oh, okay, I really like using that service, that product, whatever it is. Obviously, good investing usually requires a little more due diligence than that, but it's helpful to automatically understand what the drivers are for customers, because then you can kind of get a better grasp on what drives purchase decisions, whether or not that's something that'll last or whether that could be temporary. So I came across it looking for a remittance service, trying to transfer funds into a different currency, and I really enjoyed it, and it ended up being one of the cheapest solutions. So we're going to talk a little bit about what it is and what their business lines are, and then I'll go through some of the history so I'm going to start with the basics, what drives the business, and then I'll take a step back and walk through kind of the history. I don't know why I chose to arrange it that way, but that's how I'm going for it. So if you go to their Wise homepage, you're going to say, we are on a mission, or the webpage is going to say, we are on a mission to build money without borders. Basically.
How do you rate that mission statement?
One of the better ones, I think. It's okay, right?
Yeah, I like it. It's better than some of the old ones like Peloton, right? Or I can't even remember what they had, but some of them, of these new age companies, are quite cringy. I guess. And this one actually, it makes sense because it's basically helping people save money. And as you're going to talk about, foreign exchange fees are still wildly high for some of these legacy services.
Yeah, very high. And yeah, I'd say probably the weirdest mission statement I've ever read was the WeWork one, where it said, we are building the we economy or whatever it was.
Well, they still are.
Yeah, touche. All right, well, let's start with what Wise actually does. So they are, I'll say a platform, but really it's just a mobile app and a website that gives users a multi-currency account where they can hold, receive, send, or spend money. And they do this primarily, they basically have 4 products. There's other stuff. I mean, they say they're launching new features every day, but really there's 4 products that drive the business. So the first one is just transfers. This is what their original service was. It was known as TransferWise. It's what they're most known for. And it's exactly what you would think it is. They allow individuals and businesses to easily transfer money to people in different countries, or not even to different people. You can just transfer the money in your own account. And they charge a small upfront fee for each transfer. And the fee they charge depends on the corridor. So it depends on the country to country transfer, like which countries and currencies you're exchanging. So that's where the variability can come in. And we're going to talk about how they're able to offer the lowest rates, which that's a big crux of this entire thesis here, is that they are the low cost provider for transfers. We'll talk about that in a second, but generally it's pretty low cost for a transfer. And they have a certain part of it that's a fixed rate. And then they have some certain corridors where it's variable. So it changes. And part of that is not up to them. It's up to kind of the jurisdiction that they operate in. And they have to sometimes go through partners as well. But I'm going to talk about that in a second. Within the transfer segment, there are 2 types of customers. There's individuals like myself, and then there's businesses also like myself, because Chit Chat Stocks has a Wise account. We are customers, active customers, actually. And so on the personal side, they have 7.1 million active individual customers, and that is, I believe, monthly actives, might be quarterlies. But the annual, the people that transact on Wise annually is much higher. And so the average individual customer actually transfers about $1.3 thousand every month. And keep in mind, it's the actual transfers where they're earning money. They earn money in some other ways as well, but that's where they take that little fee. So the transfer volume is an important KPI to keep track of. And in total, Wise processes $28 billion per quarter from their individual customers. On the business side, Wise now has 392,000 business customers, so way more individual customers. However, where individuals tend to send just over $1,000 a month, businesses send about $9,000 every month. So it's a higher value customer, if you want to call it that. And these are really small, medium-sized businesses. They're not going after enterprises. This is, if you are a startup podcast, just a random example there, a startup podcast, and you wanted to market your show on an international podcast or something like that, you could have to whoever you're marketing that show with, you could have them set up a Wise account, and you can easily transfer the funds to them. They are very transparent about who the cheapest transfer provider is. And there's actually this link. If you go to wise.com/US/compare, you can type in the transaction, like what currency to what currency, how much, and it will list you out its competitors, in some cases, who is going to be the cheapest provider. Because sometimes it's MoneyGram. Sometimes it's never PayPal, but sometimes there's other providers that are cheaper, and they're really forthright about that. Sorry, one second. I'll stop there because I need to take a drink of water, but also, so I'll let Brett intervene here.
Let me comment on the personal side, or maybe in the business side as well. For anyone that can't visualize how someone would use Wise, maybe you're someone that hasn't used remittance services before. Let's say you're someone traveling to Latin America. There's a lot of different countries. It is very easy to deposit money to yourself transfer from, say, US dollars to whatever currency you're using there and have it in your Wise account. And you can pull, as we'll talk about, with their Wise card from a local ATM and get cash, but also spend it in the local currency if that's what you want. But the main choice of what people will use here is sending money. Let's say you are a European student, college student, you're in the United States, your family's over in Europe. Obviously, you need a good way to transfer money back and forth, and you'd rather not pay, the 3, 4, 5% fees on these legacy services, especially because in the digital economy, doesn't really matter some of those old things that they offer customers, and all you need to do is get essentially the money from one smartphone to the other, and Wise can do that, hopefully, as they say, as cheap as possible. And they still talk about basically declining fees to zero over time, or as close to zero as humanly possible. Is that still in that mission statement? They still talking about that a lot, Ryan?
Yeah, although the take rate's kind of stabilized lately at this. I'll talk about the rates here in a second, but let me go through the rest of the products first. So the Wise card is their second, I guess I'd call it their second biggest business, but this is just a debit card. It's powered by Visa and MasterCard. And the reason this is valuable, Brett just mentioned it, some credit cards have complications spending abroad. Same with debit cards. And even if your bank tells you, oh, no, yeah, it's no problem at all, there's typically hidden fees associated with it, or they will give you like a fake currency conversion rate. Like they'll embed the fee into the currency conversion as opposed to having a straight up fee. And it leads to a whole bunch of extra expenses. And so the Wise debit card allows you to transfer and spend money from your Wise account really cheaply. I estimate that the Wise card accounts for roughly 20% of Wise's overall revenue. It's a little hard to guess because it's categorized under other revenue, but it's the largest segment there. So that's kind of the second biggest business. It also just adds a little bit of functionality to the app. So if you're a customer and you get some money transferred in, it's more incentive to keep the money in the Wise account, right? Because you can just spend directly from it. So there's no need to transfer it out to your bank account. The third product here, which is really important, is the high yield cash account. This is, I think businesses probably use it more, but it's for individuals as well. And so if you're holding cash on Wise, you can opt in to earn interest. It's not that complicated. People are probably familiar with this, how this works. But last quarter, the total customer balances held on Wise was just under $17 billion. That's up from $5 billion 3 years ago. Wise gives you that high yield depending on what geography you're in, and then it actually earns a little spread as well. So this is really common. Whether it's, I'm not exactly sure what they're investing in. I'm guessing in the US, they're just buying treasuries and they are giving you 4.85%. And then maybe treasuries are yielding 5 and they can just capture the difference. But it is really shooting up lately in terms of the interest income here because people are saying, oh, okay, I can get 5% or 4.85% on my cash if I hold it in Wise, so I'm going to keep it there. More and more people are holding balances in Wise, not to mention they can also spend it with the Wise card. So last quarter, Wise earned $132 million in interest income from just customer balances, which is that's huge. I mean, I think it's around it's 27% of Wise's overall revenue, and it's 100% margin, right? There's no cost associated with it. So
Right.
It's helps profit margins. It's elevating profit margins relative to what they've had historically.
Okay. And that's net interest income? So
Yes. Yeah.
okay,
Sorry.
yeah.
They report it actually as a revenue line, but it's X the interest that they're paying out to the customers.
Right. Just wanted to confirm that because it is going to be a small spread and is, I guess, an advantage for them because this is not their primary business versus a bank where this would be their primary mode of making money. And just as an example for us, we have our American bank account that we use for just our business that we started up. Pretty basic one. And it pays a terrible interest rate. And we can pretty seamlessly transfer money from that bank to Wise and then have Wise earn 4.85%. So given that we don't have this daily need to spend that money, and it's not like we're a business that has that sort of liquidity problem, we can just store our money there, and it's a really easy incentive for us to go for 4.85% versus what, like 0.5% on the checking account. So it just makes total sense. And you can see why the numbers have ballooned here, especially as Ryan mentioned, for these business customers.
Yeah, and I'm going to talk about it, but there's kind of this network effect that's included as well, where if I'm constantly sending money out of the Wise account and I'm spending money out of my Wise account, it's all the more reason to keep the money there in the high yield cash account because it's right at your disposal. And I think this is a tailwind that I didn't really mention throughout the rest of the episode, but as more and more businesses operate globally and you have employees all over the world, I think it's a huge tailwind because this is one of the cheapest ways to pay them, especially if you're a small business and you're looking to outsource to certain geographies. This is really, I think that's driving a lot of volume growth for Wise. Last thing I'll talk about in terms of products is just the Wise platform. This is really a small piece of the pie, but it's basically their enterprise business. So I assume pricing is kind of custom. They're not very transparent about it, but it is basically banks, brokers, really fintechs that want to plug into Wise's payments network, which I'm going to talk about what that payments network is here in a second, instead of going through the Swift network. So they can let their customers have better remittances from their bank by using the Wise platform. To sum things up, Wise helps people transfer money. And because they are typically the lowest cost provider, it has been sticky and it's caught on with lots of customers. Wise is also layering on some additional features, which helps keep the customer funds on the platform and helps grow revenue faster than volume. I'll stop there. I'll let you kind of intervene here.
Yeah. Let's talk about the history. How did they get started? A little bit of a fascinating history with these two. I believe they're both Estonian founders. And how does the product history getting started back in 2011 lead to today and what they've built with the Wise network? And maybe to add in here, do you think there's any advantages, maybe as your conclusion here, any advantages to what they've built versus what any other fintech startup could achieve?
Yeah, so just in general, I learned this when we studied Visa, but sometimes the best way to wrap your mind around a competitive advantage or like why a business has been able to grow is to look at the history and how it actually started, because then you see what the original customers were thinking and why they latched onto the service. So I'm going to go through that for Wise and hopefully we can get a sense of whether or not we think it'll last. So Wise was started in 2011 by Tavet Henriques and Christo Carmen. And it was kind of born out of a frustration that they had where they were both from Estonia, like Brett mentioned, but they were working in London and Christo was being paid in pounds. However, he had a mortgage back in Estonia that he had to pay. So he was having to transfer money into euros. That was I think it was called Estonia. It got changed at some point, but Estonia was using euros at the time. So he was having to transfer the pounds into euros. And initially he was going about this the traditional process, going through the banking system. And as you can probably guess, he was losing tons of money to fees in the process. And here's why that process is expensive to begin with. So I'm stealing this quote from, I can't remember the exact source, but I believe it was a Wise page. It says, regular banks usually process international payments with the SWIFT network, a messaging system that's been in operation for around 50 years. It's established and reliable, but it's not often fast or cheap. That's because SWIFT transfers can involve one or more intermediary or correspondent banks moving your money along until it reaches the destination account. This takes time to arrange, and the banks involved can also charge a fee, pushing up costs. So Christo was looking for a way to get around this. And fortunately for him, he had Tavet, who was his co-founder and a friend, where they had enough trust that they could make this work. So the way that Christo kind of circumvented this transfer process is instead of transferring the money from London bank account to Estonian bank account, keep in mind here, Christo and Tavet both had bank accounts in each country. Tevet would take the euros he was receiving. He was getting paid in euros, and Christo was getting paid in pounds. He would take the euros he was receiving and put money into Christo's Estonian account. And in exchange, Christo would replace the amount in Tevet's UK account with pounds. So they were basically they were just moving the account balances up in each other's accounts without actually transferring it across the borders. That is the main principle of what Wise still does today, just at a much larger scale. So they launched this. At first they were like, oh, okay, this is kind of nifty. Why don't we set up accounts in both countries and we'll get some coworkers, whoever else is in the situation, to try to use the service. And that was TransferWise. And it worked pretty well. It caught on with a lot of adoption. Obviously, this is a pain point for a lot of people. I mean, they're just directly losing money every time. And so it's still how the business operates today. If you go and look at their company page, it says when you make a Wise payment, you fund it by sending money to the Wise local bank account in whatever country you're sending from. Wise then passes on the equivalent amount to the recipient from their account in the destination country. So it's a little hard to visualize because we're talking about so many different accounts. But Brett, if you share your screen and show what this looks like, just think about it as you have bank accounts essentially set up for you in different countries, and your balance when you submit to Wise goes up and down in the various countries, but it doesn't actually cross the border. If that is that kind of an apt way to describe it. Am I making sense here?
Yes, I think so. It is essentially a loophole that helps them save money. And I don't know exactly how they manage this, but I assume that the corridors, when I mean corridor, let's say, for example, you had Australia and Thailand there, the corridor from Australia to Thailand probably has a somewhat consistent payment base because you have your reliable customers there. So they can almost predict what the payment flows will be. It's not like the payment flows from the US to the United Kingdom is going to 10x overnight. It probably has a standard rate and it'll grow alongside with the business. But I think it's a really innovative way. Yes, obviously someone like Western Union could copy this, but then they would have to lower their fees. And it's a bit of a innovator's dilemma, which I like. And as you're about to mention here, the take rate they offer that they take on these fees is just much more attractive than what someone like Western Union or your standard bank might offer.
FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. And beyond that, they have company-specific segment and KPI data on more than 1,500 stocks. So to give some examples here, you want to see Netflix's average revenue per member over the last 10 years? They've got it. Do you like to track YouTube's advertising revenue? They've got that too. If you want to see Celsius's revenue that comes from Costco, how much of their revenue comes from Costco, they also have that. So the breadth of FinChat segment and KPI data truly is one of a kind. I use FinChat every day to track and manage all my investments. I also use it to discover new investments. And if you want to get 15% off any paid plan, go to finchat.io/chitchat. That's finchat.io/chitchat to get 15% off any paid plan. The link will also be in our show notes. Sound the alarms. We have a new sponsor alert. That's firmreturns.com. It's a stock research blog. Our friend runs that, and it covers companies from all around the globe, but it leans really more towards the UK as that's his home market, and it gives him easier access to management, and he provides ongoing updates on the companies that he's invested in, as well as an archive of longer form write-ups that you can access all for free. There is a paid tier, but there is tons of free content out there. And these reports are very thorough. To give you an example of just how thorough some of these are, at one point he was digging into a company's account, and for one company he wrote up recently, he actually managed to find a material misstatement that had been missed by the auditors, and management reached out and confirmed the error to him.
And these are companies of all different sizes, from all different sectors and all different markets around the globe, but with a focus on his home market in the United Kingdom.
If you want to check this out, firmreturns.com. Like I said, tons of free content on the website. If you're interested in one of the paid plans, you can go to firmreturns.com/chitchat. That's firmreturns.com/chitchat, and it'll get you 20% off. Yeah, and maybe I'll give an example here to hopefully make this make a little more sense. Let's say Wise has accounts in England and accounts in the US, and both accounts have $100. In America, if I'm sending money to that English account, whether it's someone else's, let's say I'm sending it to someone else. Let's say I send $50. $50 goes to the Wise account in the US. They now have $150 in the US account. That money does not go to England. The English account just drops by 50. So that money goes through Wise in two separate accounts, and the English account will then send 50 pounds or 50 US dollars in pounds, whatever the equivalent is, to the English account. So the money isn't transferring borders. I maybe I'm going over this too much, but I hope it makes sense here.
I think, it makes sense. And I would say that they're not doing this on 100% of transactions, right? But their goal is to do this as much as possible to save costs and offer, as you're about to mention, these lower fees.
That's right. Yeah. So what we just talked about, that's kind of their direct connection. That's where the lowest fees are going to be. But then there are certain countries where they still have to go through partner banks and it's more expensive. But in general, this system of local accounts has become their own infrastructure and it's way less costly. To give a little context, the global average cost of sending remittances in Q1 of 2022, so this data is a little out of date, was 6%, 6.1% actually. And that's come down over time, but that is super high. And that's according to the World Bank's Remittance Prices Worldwide report from June 2022. Wise, on the other hand, averages a 0.65% take rate. So literally 10 times less costly, if I'm thinking about that right.
As you're gonna go through the financials. It's not like they're doing this like a crazy, as you mentioned, WeWork. It's not like they're just saying we're gonna have terrible unit economics and run this business with cheaper costs, but they're actually making it work, which is quite fascinating. I think quite exciting. I will say as a side note, we probably don't have time to cover this on this episode, but when you look at Wise and you look at those fees and you look at the comparison charts, it does not make me bullish on good old PayPal. It does not.
No, it does not. And given, I don't know how much international transfers is really that big of a PayPal business. PayPal is not the largest player here, actually. I mean, the banking system is the largest player, but Wise has already kind of stolen share from most of the remittance companies. But let's give some numbers on their growth. It seems like, although I don't have data that goes all the way back to the founding, ever since they launched in 2011, they've been growing pretty rapidly in terms of customers. The earliest data I found is Q1 of 2019. So at that time, they had 1.4 million total active customers. This actually predates even FinChat's data, which is already pretty extensive. But last quarter, they had 7.9 million customers. So they've gone from, in 2019, 1.4 to 7.9 million active customers in the most recent quarter. And I think probably the most attractive part of this is they're really not spending that much money on marketing in the process. So it seems like their network effect is really beginning to take hold. In the last 10 quarters, last 2.5 years, Wise has added more than 4 million accounts. In the first 10, 11 years of its existence, it added 3.9 million. So they've added more in the last 10 quarters than they did in the 10 years prior. That's really kind of showing, I think, that the more people that are on the service, the more they become the next, saying that wrong, they become basically salesmen. They want other people to join the platform because it reduces the friction, it lowers the cost for themselves to transfer money. And in general, the remittance market is huge. It's estimated to be about $25 trillion. 50% of that comes from enterprise customers, and the remainder comes from SMBs and individuals, which is really what Wise is going after. You can see over the last 12 months, Wise has processed about 146 billion USD in volume. So it's still a small piece of that remaining, I guess you could call it $12 trillion pie, but they are starting to eat share from the remittance market. I'll kind of stop there. Do any of these numbers stand out to you? I mean, obviously the growth has been pretty impressive. Anything in particular that you liked here?
Yeah, I mean, their customer acquisition makes sense. The fact that they only have 7 million customers is also quite attractive, because if you look at someone like PayPal with what, like 400 million, there is still a long runway for Wise to reinvest, as long as, you know, the same sort of efficient marketing, customer acquisition strategy, the network effect can work for the next 7 million versus this, prior 7 million. We will talk about maybe the competitors with Remitly and stuff like that, and how Wise may be going for a different but more valuable customer base, as opposed to the immigrant corridors that Remitly is going after for Latin America. But I think the biggest thing that stands out to me, because Wise is not just going after these individual customers sending on the remittance corridors, is the fact that they're only, and this was December 2023, they are a UK company, so they're not doing quarterly reports. It's 1/2 updates, is the $146 billion, I think it's dollars, in volume versus the $25 trillion market opportunity. What is that? That's less than 1% for sure. I mean, less than
slightly. It's a little. It's about,
like either way, like the market share is so low, and the fact that they're attacking this with such a disruptive take rate versus the legacy solutions leads me to believe this is I mean, we talked about it. We covered them, I think, 2 years ago on a not so deep dive. And I think I'm in still the same position today, where it's almost a textbook innovator's dilemma situation, which can be quite attractive.
Yeah, and it depends how you characterize the market, right? So that $25 trillion, that's full global remittances across enterprise to individuals. If you cut out enterprise, it's more like 12 trillion. And that includes bank transfers and non-bank entities, so the MoneyGrams of the world, stuff like that. Then they actually are starting to have a somewhat sizable share at 150 roughly billion in volume. So they are one of the leaders globally in the remittance space. But I'm going to talk about what has actually allowed them to grow, because the numbers are impressive. And if you look at the revenue, it's absolutely insane. They've gone from $28 million in revenue to more than 1.4 billion over the last 8 years, which is just a staggering growth rate.
And I will pull up this chart. I am sharing for anyone who wants to watch these. They will be on YouTube as well, and Spotify. I am sharing a lot of these charts, and it's just going to help along. And if you are listening at this moment, these charts will be in the newsletter. It's all free. Just go check them out if you want to look at these, or go check out our friends at finchat.io. All right, I'm going to share the screen.
Okay, so what has enabled them to grow so quickly? First and foremost, being the low-cost provider just helps. It's really good for word-of-mouth marketing. When you go online and you explore your options, you're going to find that Wise is probably the lowest cost provider. I also like these situations because I love it when your customers become your best salesmen, and that seems to be happening for Wise. And it's really powering this network effect. Not to mention they've leaned into it. They had it seemed like almost an insane affiliate program, because it was just like, if you get someone to sign up and send money on Wise, for a while it was, we'll give you $100. And people were constantly doing it. Sorry if you can hear that siren driving by.
We can hear that one, but the Ryan live in the good old city of Seattle. Gotta be some sirens there. Hopefully it doesn't last too long.
Yeah, it's just a strong network effect. It's way more convenient for me if I, as a podcaster, if we're, like I said, we used this example earlier, if I'm advertising somewhere, I would really prefer to avoid the PayPals of the world or avoid the wire transfers and just have someone set up a Wise account. It makes it so much easier. So that helps grow accounts. Also, I noticed this, and I don't really know how to quantify this, but I've noticed that they're really good with content marketing in a way. So when I looked up lowest cost transfers or something on Google, you're going to find probably a Wise page, a Wise blog post that has a list of them. they're really top ranking on a lot of these services, and they've done a great job kind of getting valuable digital real estate there on the first page of Google. So I think that's helped. And then the other part that I like is they aren't really adding like useless services. Not to call out some of the other fintechs, but like adding all the equities trading and the options trading, if you're trying to do that. Like some of these fintechs are trying to add every product possible, whereas Wise has basically just added two products that really help people, right? The debit card and the high yield cash accounts. 48% of personal customers use more than one product, and 60% of business customers use more than one product. So you can see that it's actually driving some real adoption within the customer base.
Yeah, excluding that platform segment, you essentially have send, save, spend.
Yeah, pretty much.
And one question I have for you, you manage this more for us from an anecdotal perspective. I'd like to hear this. You said when you talk to an advertiser or any sort of vendor that we have, you ask them if they can set up a Wise account. How is it pretty frictionless to set one of those up? Are they really good at having people go, hey, I want to sign up for an account. It takes me 2 minutes to connect my bank account? Because I know a lot of people get frustrated with signing up for these new financial services, and it can lead them astray if they spend 10 minutes and go, I'm just not getting this working.
Yeah, I think it's pretty seamless. So full transparency, for the podcast, I don't do it. Our man behind the glass does it, which it's nevertheless, I'm sure it's easy for him as well. But I do this for FinChat, actually. We use Wise for a lot of our transfer services. And anytime that we have to pay someone and they don't have a Wise account, it's really, really easy to set up. And then you basically just ask them for their Wise tag and you can instantly send them money. So it's a very simple setup process. Not to mention there is that affiliate thing that they've got going, which seems like it'd be expensive, right? If you're paying someone just $100 for every time they bring on a new customer. But you think about the money they're going to earn over the customer's lifetime, it probably pays off, especially if it's a multi-product user and during a high yield environment.
Right. If someone's a send customer, this is just excluding debit card, excluding the bank account, which I guess isn't technically a bank account, but we don't need to get into the details there. The send customer, if over their lifetime they're sending $100,000 as a consistent remittance payer, and the fee is 0.5%, that's $500 right there.
And so I talked about what's driven the customer growth. Having a great product, having your customers become great salesmen, great content marketing, really easy to set up, self-serve is seamless. But the revenue growth is outpacing volume growth because of what we talked about. The additional products are actually getting good traction, right? You're earning the spread on the interest, and there's small fees included in the debit card as well. And the debit card really, it's basically just accretive to the transfers business, because essentially you're just creating small transfers within your account before you spend it in a different country. So they're just taking that similar fee that they're doing if you were to transfer it to somebody else. Anyway, it's kind of besides the point. Let's get to the cost. Let's get to the unit economics of this business, because this is a profitable company and a very profitable one. So I'm going to go through kind of the basics. Wise has roughly 76% gross margins, which is quite high for a fintech, especially since most companies plug into either Visa or MasterCard and they eat away at half their revenue. That's not the case with Wise, because Wise, other than on the cards, they're circumventing they don't need someone to process and settle transactions. They just need a remittance network, which they've built themselves. The bulk of the cost of sales really just comes from the bank and partner fees. So I mentioned sometimes they don't have a direct connection. They have to go through partner banks in certain jurisdictions, and that's where they're going to have to pay out those partner fees. So that's where you're getting that 24% cost of sales. But the bulk of Wise's costs come from investments in their workforce and just other operating expense lines. So of the $900 million in gross profit that Wise generated, I guess this would have been last fiscal year. So this is not trailing 12 months, which I'm going to talk about in a second. which
darn European companies.
yes, these darn European reporters.
Almost every, I know we want to talk about holding stocks for multiple years, but it is nice to get this information every quarter and not be talking about stuff that's 12 months ago on a podcast or when making an investment decision. And it is another example of, yet again, every investor relations thing in Europe is just superior in the United States.
Yeah. So of the $900 million in gross profit that Wise generated in 2023, they spent just under $600 million in operating expenses. The majority of those operating expenses are administrative, so bulking up their product development teams, their customer service teams, marketing teams. Actually, keep in mind here that they include marketing personnel as administrative expenses and not marketing costs. So when they say marketing expenses, it's strictly straight up marketing, like advertising. In the last full year, this might surprise you, Brett, they spent $47 million on marketing. And this is last year it was a $1.2 billion revenue business. Does this surprise you?
I don't think so, given the fact I knew they were profitable, but it's nice because they don't have to spend that much to acquire customers. And if they want to, let's say they want to inch this up to $100 million, $200 million, $250 million over the next 3 to 5 years, you can see, given the unit economics of, the margins you're going to talk about here, the gross profit levels, you can see how they'll still get positive returns, even if they have to inch that up. So it's just gives them flexibility. It's a nice place to be.
Yeah. And as far as their, sometimes these younger companies, I can tend to have gripes with the way they manage the income statement. But with Wise, I tend to like it. It honestly reminded me a little bit of Adyen in that they have kind of managed expenses somewhat well. Here's a quote from the last year's shareholder letter. He says, "Gross profit provides us with the capacity to cover our operating expenses, invest in building a better experience for our customers, and of course, provide a healthy and growing stream of profits to our shareholders. Through reinvestment, we deepen our competitive advantage with infrastructure and products that continually improve, attracting more and more customers, which leads to more gross profit to reinvest, and so the cycle continues." Beautiful. I like the way they think about it. They had 30% roughly operating margins last year. So they aren't, and if you actually look at the salaries of a lot of these employees, it's way less than what you would have to pay if you were based in a San Francisco or a Seattle or any US based fintech, really.
Or New York. Yeah, that is the beautiful thing of Europe. Thank you guys over there for helping the margins stay so high. But I mean, it makes sense because they began in Europe. They have, I believe the original market was the United Kingdom. That's where they're launching. Usually they're like, when they have a new product, that's the first place they typically launch. I believe that's where their headquarters is, correct? So it makes sense that they're centralized in Europe. That's where their core market is.
Okay, let's go through the management team here. I think I've covered the business fairly well. I think it's advantaged. They've built out their own infrastructure and it's growing really quickly. And it seems like a business where...
Go ahead.
I was going to say, it just seems like a business where growth begets further growth. That, the more people that are on the service, they become salesmen for the service itself, and it seems to just kind of compound that network effect. Earlier in the show, you heard us talk about the investing platform, public.com. That's where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only.
Yeah, and I was going to say our 3 questions that we like to ask are, is there any sort of prediction that we can make on the durability of growth or the durability of earnings due to a competitive advantage? And then we're going to talk about management here. Then another thing that we talk about, which we'll talk about at the end, is valuation. Those are our 3 key criteria to investing in a stock. Can we say, or at least can you say, I guess you know this business a little bit better than me now, are you confident in that first question, that first box on the list being ticked, that the competitive advantage is there and can grow as they scale?
Yes, The only concern is that there are certain areas where I don't understand the compliance. I don't understand what it requires to set up accounts. I don't know if the ruling body or the governing body for payments can restrict them from having an account. My only concern is that there's some way that it could get disrupted by certain governments, but because they have so many corridors and there isn't any one currency that's really driving the business, I think it's probably built to last. But let's go through the second question. I think that was the second question there around management and proxy. They only report the compensation for two of their directors, which I found kind of interesting, the CEO and the CFO. Another gripe I guess I have with the proxy statement is there isn't a proxy statement. It's just included in this super long annual report. But as you can imagine, they follow similar strategies to that of American companies. They pay them a base salary, an annual bonus, and long-term incentive awards. Their long-term incentive awards are based on two factors. One, total shareholder return relative to the FTSE 250, and two, volume growth. I honestly don't think that's too bad. What do you think?
Better than adjusted EBITDA. Yeah, total shareholder return relative to the FTSE is it's okay. It's probably better than, again, just saying we're going to hit a weak adjusted EBITDA target and then do that. But volume growth, I think, is nice because that's a nice incentive they have. If they're trying to expand their competitive advantage, volume growth is the number one thing you need. It's just the number one thing that's going to drive this business. So I like that one.
Another interesting sentence that came from the proxy statement. It says, executive directors are required to build and maintain a 300% base salary minimum shareholding whilst in employment and for 2 years post-employment. So basically, if you're an executive director, you have to have, 4 times your base salary in worth of Wise shares. And that extends 2 years post-employment, which we're going to talk about here in a second, is actually quite important because there's been a CFO resignation. So it's not like he owns that many shares, but if someone like Christo Carmen had to sell shares, there would be a 2-year post-employment thing where he has to own more than 4 times his base salary. Let's talk about the share structure because it's a little wonky. So Wise has a dual class share structure where Class B shares are worth 9 votes relative to Class A shares being worth 1. In total, the company has 1.4 billion total shares outstanding, 72% are Class A, 28% are Class B, and Christo Carmen owns 26% of all the shares, but has 48% of the voting power. So he really runs this company, 48% of the voting power. Basically, he can make the decisions. It would be hard to replace him when he's got 48% of the voting power, because you would need every other shareholder basically to be in agreement against him on any votes. The other part that's important here is the Class B shares. They have high voting power. You can't buy them. They're not sold to individual investors or anything like that. And they have no economic interest. So as far as dividends go, I guess it's really dividends. You're not getting paid out anything for the Class B shares. And they're also not really included in the market cap calculation, which is very important. So a lot of the aggregators, FinChat, for example, have the right share outstanding balance. If you looked at it purely based on the annual report, you would think it's got 1.4 billion shares. It does not, which that's actually quite the difference in the market cap and the valuation. So just important to remember, base the market cap off of your Class A shares. In general, I thought this was actually a pretty good proxy. However, there have been some departures at the company, which left me a little confused. So for starters, Christo Carmen had some tax troubles in 2022 with the UK and had to pay a big fine. It sounds like he basically just didn't have his own personal affairs in order. He had to pay a fine. It's kind of in the past now. But then last year, he took a couple quarters off as CEO. There was an interim CEO that came in. And at first I thought, is this related to the tax trouble? But then he says it was for paternity leave. So he wanted to be with his firstborn child during this time, which I guess I get. I would imagine for someone with his wealth that he would be able to pay for care, but it sounds more like he wants to just be there during this time period. So I understand it. He's back now. It was just kind of a weird period to have an interim CEO for a little while around his tax trouble time as well. So strange. But then it gets a little stranger. Matthew Briers, the CFO, left the company or is leaving the company this year. At first, I was a little worried by this, but it turns out he was hit by a bus and now he's basically retiring to focus on his health. And I mean, I don't think we should read too much into this. He apparently it was a really bad accident and he left for a little while. He ended up being okay, kind of came back for a year. And now he's saying, I'm going to retire, just focus purely on my health. He's been the CFO since 2015. So if it were like constant new CFO coming in and going, then I'd be concerned. But I think with this, it's not really that big of a worry for me.
Yeah, just a lot of odd things happening here. It's interesting that the founder would leave like that, because if you have the interim CEO, but you're going to be back in a couple months, I'm sure he's like kind of still directing things, but just from his paternity. I mean, that's what I would imagine. I would be like, if I was the one that owned half of this business. The CFO thing, obviously, that that can happen, and it's just kind of strange. But I think this founder, he seems to not care about, or he doesn't really want his, he wants to be private. He doesn't want to be public, his personal life, all that good stuff. And the tax thing, I guess it's a slight yellow flag, but not a giant concern. If something like that repeated, I would be concerned, but nothing crazy. It's just kind of weird things happening with the management team that hopefully, we don't want more executives getting hit by buses. Hopefully that's behind them.
Yeah, I think in general, the CEO and founder who has built this business from scratch and done a really good job scaling it profitably owns 50%. He's well incentivized for this thing to keep growing. The CFO, it's kind of a bummer that he's leaving because I actually thought he's done a really good job. But it's not like a concerning departure. And then the proxy statement itself wasn't too concerning at all. So I think management kind of checks all the boxes I'm looking for. Let's talk valuation, though, because this is where I think it gets pretty interesting. My preconception here was that I'm going to go through this. I'm going to like the business. I'm going to think it's promising, and then the valuation is going to keep me out of it. But after doing a little digging, I don't think that's the case. So if I use the share count from FinChat, which is the correct share count, Wise has a current market cap of 10.3 billion USD. They have 1.1 billion in cash equivalents and $130 million in deferred tax assets. So around 1.2 billion in cash, roughly. They have $358 million in short-term debt, which is through a revolving credit facility. So too long didn't read here. $10.3 billion market cap, 900 million in net cash, 9.35 roughly billion enterprise value. Just think little under 10 billion. Now, they don't report their income numbers until mid-June. Here's where it gets kind of weird. So they report like an official annual report with all the details every year, mid-June, and then they have a half-year report. But in the quarters in between, so Q3 and Q4 right now, they give a business update, but they don't release the annual report. So we know what the revenue numbers were for Q3 and Q4, but we don't have the income numbers, and none of the aggregators, CapIQ, FinChat, whatever you're using, can track it because they haven't put out the official annual report. So a lot of the metrics that people are valuing this business on are way out of date. So I'm going to try to value this thing, and there's going to be some guesswork involved here. But in the first half of the year, Wise generated 35% free cash flow margins. Now, in their little Q4 business update, they said that the gross margins in the second half were higher than the first half. I can't imagine why that wouldn't trickle through to free cash flow. I mean, they're getting more and more revenue from this interest income, which is like virtually 100% margin. So it seems like free cash flow margins would trend upward a little bit. So I am guessing for the second half of the year, free cash flow margins were around 36%. That would imply $346 million in free cash flow in the second half and $652 million in free cash flow for the full year. This is US dollars, right? $652 million full year free cash flow. All that is to say, if that's the case, if that's how much they did for the full year, they have an enterprise value to free cash flow of 14 times. That is way lower than I was expecting, and it's way lower than their trailing multiple if you go to the major aggregators. So I was pretty impressed by this, and well, I don't know if I'd say impressed, but I was excited by it. And frankly, I think a lot of people are valuing it wrong because they don't have access to the income numbers, which is kind of frustrating. But
yeah, I think that I can get with this. One thing I would say is some of it probably a working capital advantage, right? So maybe free cash flow a little bit. I mean, yes, they have that advantage, but it's not, the underlying earnings, as you said, 35% margin versus the operating earnings at 30%. So not a big deal, but maybe valuation slightly higher. But yeah, it does seem cheaper. And I did a little quick check here while you were talking on FinChat. It seems like stock-based compensation. Yeah, they had the IPO, so shares outstanding jumped up a ton, but it seems like stock-based compensation is quite reasonable. So not too much there that you see with some of these fintechs, these software companies touting those 35% margins on free cash flow when they're spending 10 to 15% on SBC as a percentage of revenue every year.
Yeah, they're like true operating or net income figures are really not that far, or their NOPAT numbers really aren't that far off from the free cash flow or adjusted EBITDA figure. They talk about adjusted EBITDA a lot. Their adjusted EBITDA is 95% of it converts to free cash flow. So it's actually quite accurate. But yeah, as you mentioned, not that much dilution. I think I read this part of the 10K, or not the 10K, the annual report where they said it was something about we don't want more than 10% dilution over the next 10 years.
Not bad.
So that would be, the growth per share would still be great here, assuming that they continue to grow the way they have. So I'm going to do a little bit of modeling out here. I think it's reasonable that Wise could grow volumes by at least 10% a year for quite a while. They have certainly grown at that pace over the last 5-10 years. And as I mentioned, there's a lot of tailwinds behind them with globalizing businesses, right? More and more people employing people elsewhere. The customers are becoming the best salesmen. So customer count is growing much quicker today than it was nominally. It's growing much quicker today than it was 3 years ago. People are using it for multiple services as well. So I think volume is well positioned to grow by more than 10% a year. Revenue will grow even quicker because of that interest income. Now, obviously, if interest rates were to plummet quickly, I think there's some risk here that the interest income could go away, but my assumption is 15% revenue growth for 5 years and steady free cash flow margins, because I can't really see why they would change. If that happens, you'll get $1.3 billion a year in free cash flow. I don't think we need to go through that much difficult math here. For a company with a $9.4 billion enterprise value, a growing company, if you're getting $1.3 billion in free cash flow, it's cheap. It really is. So I really like it. I think the valuation is very reasonable, especially for a business that I think has tons of upside in terms of volume growth. Were you expecting the valuation to be different here?
I was expecting it to be a little higher, yeah. And I guess the stock is down. I would have to maybe investigate a little bit why that is. Maybe it's this management stuff that people are concerned about, but it is down. And I remember looking at it before and thinking it was a bit expensive. So I guess that's good. They've grown into the valuation, and stock's down recently off of its all-time highs. I mean, I want to talk about risk and maybe a little bit on the competition. I know some people have talked to us about Remitly being a stronger company. I pulled it up on FinChat as we were talking here. That's the nice thing about the platform, is you can kind of chart and compare these companies. Remitly has been growing revenue quicker. Does that concern you at all? Or, I guess I might answer this question myself. I don't think it would, because there's probably room for quite a few players, especially if they're targeting different niches, where Wise is going for richer customers, Remitly is going for the Latin American immigrant corridors more. Does competition concern you at all? And maybe the relationship with Visa and MasterCard, because I know they've talked about getting into Forex a little bit more. Is that a partnership or I don't know. What do you think about that as I know the term's overrated, but maybe it's not a black swan, but a white swan risk of Visa and MasterCard kind of having a lot of control at the end of the day.
So I'm looking at the total active customer count here, and this might be slightly off, or they might characterize it differently, define it differently. Looks like Wise is a little bit larger. As you mentioned, the corridors are a little bit different. I think both of them can work out. In general, Wise is lower cost. Wise has more products in terms of driving incremental revenue from its existing users. I guess I'm not too concerned with Remitly. Remitly has certainly carved out a good niche with that demographic that you discussed, but I'd probably be more concerned with Revolut. They seem like more of the formidable competitor, but they're private, so it's hard to get a whole lot of numbers on them. I believe they said they had 9 million active customers, so a little larger than Wise and Remitly, but once again, it depends on the definition. If you do annual active customers, Wise is probably closer to Revolut's figures. So I'm not really that worried about competition. It's something where it seems like it would be hard to replicate the network of bank accounts in different countries and partnerships with different banks. And you already have it here with Wise. And it's not like they are mortgaging their moat where they raise prices the way PayPal did on transactions so that you can no longer, that it invites competition. I mean, if I'm looking at this, I think, one, I got to set up the network, and then I got to try to be a lower cost provider than Wise, which is already pretty tough considering that they're 10 times cheaper than the banking network. So I'm not too worried about competition. What would really concern me is if we started to see the take rate rise. If we started to see Wise's transfer take rate, keep in mind they can earn revenue. They can earn revenue in different ways that maybe makes the take rate look higher. But if the take rate on transfers starts to climb up, or maybe they stop reporting it, I would be concerned that they're maybe going the way of PayPal and taking advantage of their customers in a way. But that just really doesn't seem to be the case here.
Yeah, it is interesting where you can look at them having this network effect, but also potentially the economies of scale where the moat, the competitive advantage can widen as they scale and are able to reduce the costs, which, there's classic examples of this out there. You can think of the retailers like Costco or Walmart that drive stuff like this, Amazon as well. Obviously, this is an entirely different industry, but that sort of thing can, I think, be quite attractive where the moat comes from us continually trying to reduce costs and be efficient in that manner. I would almost want to see them maybe not even expand margins that much, because that is where you get opened up from another digital competitor who can come in there. I'd not even spending on marketing, but giving back to your customers, because then you just create a much loyal customer base. That's one thing I'd maybe be concerned about is pricing and the margin expansion. I guess they're still the lowest cost provider, but right, if they can go at higher margins, it's a little bit, I would say, not confusing, but it's a little bit conflicting when you're saying you're the low cost provider and having these high margins when someone like Costco always has the low margins. If you kind of get what I mean. I know, again, I use Costco as a comparative there. It's not the same industry, but yeah. And what about
the issue is that, yes, they could maybe pass it through in the form of lower costs, but the other way that they would have to do it is they'd have to just hire to keep margins low, or spend a ton on marketing. I'd be fine with them spending a ton on marketing, getting the word out there more and more, but they almost don't need to. I mean, they haven't been.
I guess like Adyen is still the low cost provider for their niche, or somewhat maybe low cost, or also just the highest value, and they have those really, really strong margins at 50% off of that net revenue. So maybe it's not the apples to apples comparing it to the retailers. It's just something that came to mind. I know this is one that would be tough to answer, but maybe you mentioned the government stuff. Any sort of international transfers from, the Federal Reserve hyping up stuff with all their digital coins and all that stuff. Any concern there that could be a disruptive event for them if the governments get their act together? But I guess maybe betting on that is, you could have said that every year for the last 15 years.
Yeah, it seems unlikely just because for a lot of the governments, especially ones where they have like a nationalized service, this is kind of a cash cow, is trying to go transfers through them. So it seems unlikely that they would come up with a frictionless free service. And in general, betting on the government to come up with a great software product that serves customers really well and is easy to use and is low cost is probably been a bad bet historically, and I'm guessing would continue to do so. So,
right.
No, I just, some governments maybe disintermediating them in some way is a risk. They rely on a lot of partners throughout the world, but I would say that's also like an advantage as well, because it's that much more of a pain point for the next startup to try to build those partnerships.
Right. And I guess kind of thinking through it, they are what I know this term is used over and over, but a non-zero sum player where they're making their customers happy with lower fees. They're making the governments happy because they're part of, they're giving money to them, as you mentioned, and also they're keeping their citizens happy because they're not just giving. I know I would be frustrated if I was a government and I was like, look, we got these people traveling to Europe and the United States, and they're just having these European banks and United States banks taking 3 to 5% off of all their money for no reason. I would be like, let's change that. And Wise seems to be helping them out in that regard. And they offer these high interest rates. They're also helpful to Visa and MasterCard because they're attaching hopefully more cards to the network. Seems like a win-win-win scenario.
Yeah, it is kind of a scale economy shared type business, that whole Nick Sleep principle where they've got a cost advantage, they are passing it through to customers are bringing more volume, which can further feed their cost advantage, which that's a great self-reinforcing cycle to have.
That's not a bad place to be. All right, let's close things out, Ryan, as we do with these stock research episodes. Are you buying shares today, putting it on the watch list, disregarding it? What are your final thoughts on Wise? And I will give I forgot to talk about this on the Portillo's episode. We should talk about it in all of these. When we say we're either like not going to buy it or whatever, we always wait probably like a week before actually buying shares. We never want to do anything, even if it's a really large company, where we're buying right before we put out an episode. That just doesn't feel ethical to us.
Yeah, I think the chances of me moving this stock are probably pretty low. So
we play it safe.
We play it safe anyways. Yeah, this report, I guess, finally put me over the edge. I had an idea that I wanted to buy this because I was so wowed with the customer experience and I use it so much in my own personal life that it was up there on the watch list for me. And now I feel confident enough to kind of put some money in it. Now, like you said, I'm going to wait, I don't know how long, just for the purpose of being ethical, but there really are just so many things going for them. Their network is a real advantage that should continue to drive growth in accounts. The more functionality that they provide to customers, the more likely they are to keep money in their Wise accounts. And that means more revenue for Wise. So I like that. And it's really not that costly of a business to grow. Like if you think about it from management's perspective, yeah, it's pretty asset light. I could see this being a really profitable business in the future and quite the cash flowing machine. Now the only bummer is that they report the way European companies do, which is irregular and frustrating.
Yeah, and they do have, I assume they're on the London exchange, but they do have a US ADR, correct?
Yeah, I can't remember what it is. It's fairly liquid. I was looking at it today.
Just fair warning for people. Make sure you're researching the one that's the best for you and whatever country you are in. All right, I think that's a good way to close it out. Is a nice example of when you can find the combination of anecdotal evidence with a stock but also the combination of the data backing it up. And when you have those two together, I think it can lead to some promising opportunities, obviously, when valuation, checks out as well. All right, I think that's going to do it. Let's hit the disclosure. We are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in, and we'll see you next time.